Well, hi guys. We're going to start chapter 21, which is the second chapter in this three-chapter set dealing with budgets. Hopefully, if you've had a chance to take a look at the chapter 20, dealing with the budgeting process and the order in which budgets are prepared, starting with the sales budget and working its way down. Now we're going to take a look at what are called flexible budgets and standard costs, and we're going to break this chapter into two videos. This first one will be the shorter of the two, probably half hour, 45 minutes. And the next one will be closer to an hour. So we're going to get that one loaded toward the end of the week. Excuse me. So what we're going to be looking at in this video is dealing with fixed versus flexible budgets. The next video will be the material and labor standards and overhead variance standards. So we're going to do those both in the next video together. So anyway, let's talk about what a fixed budget is and what flexible budgets are. Zip forward here a little bit. Everything you need to know is in the book here, so I'm going to kind of follow along with what's in the book. Okay. Now we know that companies use budgets for basically for planning and control purposes. They use it first to plan out their operations, and then, of course, while the year is progressing, they refer back to the budget. They compare their actual results with the budget at periodic times to see how they're doing, and if they're on budget or if they're off budget, if there's some corrective action that needs to be taken. That's a budget is a good tool for control purposes as well. And once the managers or owners of the companies determine if there is a variance in the budget, they actually give that feedback back to the people who are in control of it so that they know whether corrective action needs to be taken or not. So when preparing a budget, most of us think of a budget as just the revenues and costs at one particular level. What do we want to sell this year, and therefore if I do sell that, what's it going to cost, and how much money should I make? And that's what's called a fixed budget. A fixed budget is a budget, and it could be a sales budget or a production budget or an overhead budget. It's one of the budgets, but it's actually at one level of activity at a single predicted amount of volume. What are my sales going to be at 50,000 units sold? Or what will my material costs be at 50,000 units sold? It's just at one level of activity. And it's also called a static budget because it really doesn't change. It's a fixed budget. A flexible budget, however, actually reports what revenues and expenses costs should be at various levels of activity. So, for example, looking at this half of this grouping, this is a fixed budget. If I have sales of 100 units, then my sales should be 80,000. My costs are budgeted at 56. I should make $24,000. That's a static budget, a fixed budget. But notice here, they've actually expanded it out, and they've said, well, we know that we may have 100 units in sales, but maybe we'll have more. We could have 100, we could have 120, we could have 140. So what would our sales be if we did at those three different levels of activity? What would our costs be, and therefore what would our net income be? So really a flexible budget is just a budget at more than one level of activity. And really a flexible budget, this particular flexible budget is really made up of three static budgets. You put them together, voila, you've got a flexible budget. Flexible budgets are good because I don't know what level of activity I'm going to be at. So here's the example of a fixed level or a fixed budget preparing a performance report, which is how did the guy do? Let's measure how we did for the first period of time, and then we compare that with the fixed or static budget. So here's our fixed budget. Let's see, fixed budget report. Okay. So let's first concentrate on this one. Let me see if I can get this all on one screen. Yeah, okay. So here's what the company started off with, and I'm gonna do something here. I'm just gonna put it here. here's what the company came up with. They came up with a budget, a monthly budget at one level of activity. They said what we're shooting for in this monthly budget is 10,000 units, to have 10,000 units sold. And if in fact I do have that 10,000 units sold, my sales will be $100,000. And then here's my cost of goods sold: materials, labor, overhead, my various overheads, my selling expenses for those 10,000 units sold, and my general and administrative expenses for those, at that level, 10,000 units sold. So I should make what? $12,000. That's my fixed budget, because it is the revenues and expenses that I'm budgeting at 10,000 units of sales. Now, suppose we come up with 12,000 units of sales. 12,000. We actually sold 2,000 more than I thought I was going to. So, of course, here we are at 2,000 units of sales. We had sales of 125,000 and direct material, all my costs. Now, if we say, okay, well, let's compare that. Let's compare our budget, compare our actual revenues and costs for the month of January here. Let's compare them with the fixed budget. And look, we are going to compare each and every line item. And notice that there are no minus signs here. If we're over or under budget, we actually indicate that with an F being favorable or a U being unfavorable. Now, it's favorable to be over budget on revenues, but it's unfavorable to be over budget on costs. So you have to just use some common sense here. And we say, well, my sales, I actually sold 12,000 units, and the sales for those were 125,000. My budget's only 100,000, so I am $25,000 over budget on my sales, and that's good. That's favorable. Look at my direct material costs. The direct material costs were 13,000. Budget was 10. I'm 3,000 over budget. That's unfavorable. Direct labor. Actual came in at 20,000. The budget was 15. 5,000 over budget. Unfavorable. And wow, yeah, we are over budget on all of these costs with the exception of depreciation. We were right on budget. Supervisor salaries, right on budget. Commissions were more than we budgeted. Shipping expenses were more than we budgeted. So who's the only hero in the factory right here? The only hero is the sales guy. If you think about it, he's the only hero. The production guy, the guy who's making the stuff, boy, he is in trouble, way over budget. The selling, the guy who's responsible for the selling and administrative expenses, he's in trouble. But some of you have probably already figured this out, that these are the revenues and costs that should have occurred at 10,000 units of sales. They are not what we should have incurred at 12,000 units of sales. I would expect my sales volume to go up, my sales amount to go up, and I would certainly expect my costs to go up because I had to make more to sell them. So you really can't compare the actual results at one level of activity, 12,000 units, with what they should have been at 10,000. I should actually compare what they should have been at 12,000, which requires me to prepare a flexible budget. Now, all I need to do to prepare a flexible budget is I'm going to start with my fixed budget, and I'm just going to explode it. I'm just going to use these amounts to determine what the revenues and costs should be at maybe a couple levels below it, maybe a couple levels above it, and then we do that in just a multi-step process, and it's not too bad. I'm going to go to the next section where they talk about preparing flexible budgets, so I know what the revenues and expenses should be at various levels. I'm interested in this case to know what they should have been at 12,000 units, not at 10. So to prepare a flexible budget, three-step process: identify the activity level, such as units. How am I measuring activity? And here I'm measuring it in number of units sold. Identify the costs as variable or fixed. Revenues are always variable. And then compute or expand out the cost base on their whether they're variable or fixed. Gosh, my voice is kind of starting to go a little bit, but we'll make it here. Okay, so here's what we're going to do. We've taken the static budget of 10,000 units that we had before, and these are the very same numbers. These are the exact same numbers. We were supposed to make $12,000. I think those are the same numbers, aren't they? Yeah, we were supposed to make $12,000, and we just broke it out. We rearranged the costs into variable versus fixed rather than product versus period costs. So let's just run down the line here. Direct materials, that's a variable cost. The more units I produce, the more that cost is going to be. Direct labor is variable. Factory supplies, I would say, is variable. Utilities are variable. Depreciation, fixed. Supervisor salaries, fixed. They get paid the same regardless of how many units that we sell. Sales commissions, variable. The more I sell, the more the commissions I'm going to have to pay. Shipping expenses, obviously, the more I sell, the more I'm going to have to ship. Those are variable. General administrative expenses, I believe these are probably all fixed because they have to do with the overall company rather than what I'm actually producing. So they've rearranged them into, well, I guess office supplies. They've determined office supplies were variable. So then in our homework problems, they'll tell us what they are. So anyway, so here we've rearranged them and we've got our sales and our variable costs at the 10,000 units as well as the fixed costs at the 10,000 units. So what I want to know now is I'm going to prepare a flexible budget. What should all of these revenues and costs be at 12,000 units, 14,000 units? I could do it at any level. I could do it at 8,000 units, 9,000 units. I could do it at 12,629 units. I could do it at any level I want, but they're just going to add 2 more on here, and we're going to do it we're going to prepare these based on where we are at 10,000 units. So for the sales and the variable costs, we want to know, well, what are these? That we knew what the total sales would be for 10,000 units, and we knew what the total variable cost was going to be for the 10,000 units. What does that come out to be per unit? Well, it looks like the sales are running at $10 a unit. That's how they came up with $100,000 for 10,000 units. Direct materials looks like they're running at $1 a unit. Direct labor, $1.50 a unit. So just notice, all they're doing is they're taking the sales and all the variable costs and dividing it by the number of units to get the per unit amount. We do not do that with fixed costs. Fixed costs are just fixed. There isn't a per unit amount. They're fixed. Once I get the per unit amount, and I know what the fixed costs are, can I determine what my sales should be at 12,000 units, what my variable costs should be at 12,000 units, and what my fixed costs should be at 12,000 units? Absolutely. 12,000 units at $10 a piece for sales. Sales should be 120,000. Direct materials. If it's $1 per unit, well, yeah, it may be $10,000 at 10,000 units, but my budget is $12,000 for 12,000 units and $14,000 for 14,000 units. Notice as my level of activity goes up, the budget or the expected amount of these variable costs increase. And it's just the number of units times the unit cost expanded out. Fixed costs are fixed. Just copy and paste. They should be the same at whatever level of activity I have. That's why they're fixed. So now we have a flexible budget that includes the levels of 10,000 units, 12,000 units, and 14,000 units. Now recall where we were. What we actually attained was we sold 12,000 units, and these were my actual sales and my actual costs. What should I be comparing these to find out how I did? I should be comparing them to this column, the 12,000 unit column. So let's do that. Let's redo that budget, that performance report. And the performance report is just comparing actual results to budget report, to budgeted. So here's the flexible budget. They've just reiterated this column. They've just copied this $12,000 column right here. This is the budgeted amounts for revenues and costs at 12,000 units. And here's the actual. Now let's recheck the variances. How much were we off of? How much were we off of the budget amount based on the level of where I should be? Well, sales was we were 5,000 more. Remember on the last one it was 25,000. Well, that wasn't right. We were comparing apples to oranges. Here we are $5,000 more than the budget at 12,000 units. Therefore, I'm 5,000 favorable. Direct materials, well, the actual was 13, but the budget for 12,000 units is 12,000, so I have 1,000 unfavorable. Notice we don't have any pluses or minuses. We just put whether it's over or under budget, and or we actually put whether it's favorable or unfavorable. And being over budget on a cost is unfavorable. Direct labor, well, we were over budget 2,000. Factory supplies, though, oh, we were 300 under budget. That's favorable. Utilities, 400 over budget. Sales commissions, right on the money, no variance. Shipping expenses, $500 under budget, favorable. And office supplies, $800 under budget, favorable. So we end up with a total for the variable costs. It's just adding these. We came in over budget, 1,800. And a way to check that is the difference between these two. It's also these all netted out. If you consider the under budgets or the unfavorables negative and the favorables positive, they all net out to a unfavorable variable cost being over budget. So my contribution margin now, how much was my contribution margin off? And remember, contribution margin is revenues minus variable costs. Well, we were over budget. It's a little bit higher than what they said it should be. By how much? 3,200 favorable. And that's my 5,000 favorable sales minus my 1,800 unfavorable variable cost variance. Nets to those two net to a $3,200 favorable. So it not only works across this way, but it also adds down. Looks like all my fixed costs were on the money with the exception of insurance. Insurance came in a little bit more than it should have, 200 unfavorable. So in total, my total fixed costs here are 200 more than they should have, unfavorable. So my bottom line net income, check it out, I'm 3,000 more than that level on the flexible budget, which is my contribution margin, partially offset by a little $200 unfavorable fixed costs, gives me a $3,000 favorable budget. So the sales guy, he wasn't such the hero that we thought he was, and these guys aren't as bad as we thought they were either, because we were actually comparing how they did at 12,000 units. You can't hold them to the standards at 10,000. You've got to compute the new total amounts for revenues and variable costs at that level. Excel is an excellent program for doing variable budgets. If we have a flexible budget, I could simply put in another row that just divides every one of these by the number of units. Actually, it's based on this thing up here, by the number of units. And then whatever level I want, I would just multiply that times the unit cost. Preparing a flexible budget at various levels of activity. That's the way it's actually done. And really, that's the end of this section. The next section deals with standard costs. This is going to be where we're going to spend probably about 75% of our time in this chapter. But one of the homework problems has to do with flexible budgets and converting that one level static fixed budget into a multi-level flexible budget. And then after a month goes by or a quarter or a year, and we determine what level we actually attained, we compare our revenues and expenses that we actually incurred to the proper level as computed on the flexible budget to determine if we're over or under budget and if any corrective action needs to be taken. So anyway, that's the first part of the chapter. I don't want to get into the second part quite yet until we have time to do that. And so get familiar with this, and in the next day or two, we're going to go through this, and we are going to discuss the variances, how to compute the variances, and hopefully I'll be able to show you an easier way to compute this than what's in the book. So anyway, have a great day, and I will be in touch in a day or two with the second of these two videos.